Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our conventional tanker market update for January 2017. Now, since we're at the start of the year, it's probably a good time to recap what happened in the tanker market during 2016, and then we'll look ahead a bit to 2017 and beyond. Now, in 2016, earnings across the tanker sectors did average lower than 2015, but they were about the 10-year average, so it's still a pretty decent year for the tanker market. The VLCCs were probably the best performing sector. VLCC rates averaged about $35,000 to $40,000 per day. And that was because VLCCs were supported by really high levels of crude oil production, especially out of OPEC. In fact, in the fourth quarter of last year, OPEC production was at a record high. And we also saw high levels of imports, particularly into China, and that was for both consumption purposes, but also for stockpiling. The crude futures curve was in contango for most of last year, which really incentivized people to buy oil and to stockpile it in anticipation of higher prices in the future. The mid-sized sectors performed a little bit below the 10-year average, and in particular the Suezmaxes underperformed a little bit, and I think that was due to the production outages that we saw in the Atlantic Basin during the middle part of the year, particularly in Nigeria. Nigerian production is usually right around 2 million barrels per day, but in the middle of last year, production fell to about 1.4 million barrels a day, and that really impacted on the Suezmaxes that normally load out of West Africa. We also saw in 2016 that tanker fleet growth was probably a little bit higher than we expected at the start of the year. On a net basis, the tanker fleet grew by about 6% last year, and it wasn't really the delivery side that surprised us, but there was very low levels of scrapping. In fact, scrapping last year was the lowest since 1989, and that followed on from a very low scrapping year in 2015 as well. So not very many tankers were removed from the fleet, and we had higher levels of deliveries than were expected. However, in the latter part of the year, during December and into the early part of January 2017, we have seen some pretty good rates. In fact, earnings in December were probably the highest in about a year. And that was driven by both seasonal and structural factors. On the seasonal side, we did see some weather delays during December through the Turkish Straits, for example, and also fog in the US Gulf. And when you get those weather delays, it ties up ships and effectively tightens available fleet supply. So that's a positive for the tanker market. December was also probably the peak for refinery throughput. And I think what we also saw in December is we saw very high levels of oil production out of OPEC prior to the production cuts, which are coming now in the early part of 2017. And I think we saw a lot of buying and stockpiling in December as well, again, in anticipation of OPEC supply cuts and potentially higher oil prices in 2017. So coming into 2017, in the early part of January, we've seen pretty good tanker rates, but those OPEC production cuts are coming. We understand that the core Middle East producers, that's Saudi Arabia, Kuwait, the United Arab Emirates, and Qatar, they are following through with their supply cuts from what we understand. And those four countries are probably responsible for about 70% of OPEC's pledged supply cuts of 1.2 million barrels a day. So that will impact the market as we go through the rest of Q1 and into Q2. It means less cargoes coming out of the Middle East, which is obviously going to be negative for tanker demand. That could be offset a little bit by more Atlantic barrels going to Asia. What we're seeing with OPEC cutting production is that it's narrowing the spread of Middle East crude, the price of Middle East crude compared to the price of Atlantic crude. So what we might see is buyers in Asia, in places like Japan and China and Singapore, preferring to take some of that Atlantic crude versus Middle East. And that would be good for ton miles. It won't fully offset the impact of lower volumes, but it will offset it a bit and probably mean that the impact of the OPEC cuts may not be as severe as probably some analysts are expecting. Nevertheless, we do think that the tanker market will decline going into Q1 and Q2, and there's also a lot of ships due to be delivered in the next few months as well. As I said, in 2016, the tanker fleet grew by about 6%. In 2017, we think that that will come down on a net basis. We think the tanker fleet will grow by about 4.5%. But in certain individual sectors, the fleet will grow much more strongly, particularly in the Suezmaxes. There are about 65 Suezmaxes due for delivery in 2017. And even if you take into account some slippage on the deliveries and a bit of scrapping, we still think that the Suezmax fleet will grow by about 8%. And a lot of those deliveries are front-loaded into the first half of the year as well. So on a net basis, if we look at supply and demand and we think about OPEC supply cuts, lower volumes available for transportation, potentially a flatter oil futures curve, which means less incentive for stockpiling, also potentially higher oil prices, which will put pressure on earnings because of the higher bunker costs, and then also the fleet growth as well. I think there are a few headwinds which mean that the tanker market will probably see a decline in earnings during 2017 compared to what we saw in 2016 and 2015. However, I do think it's a case of short-term pain for long-term gain, because I think when we get to 2018 and onwards, the tanker market looks much more well-balanced, and I think we will see some pretty good tanker rates towards the end of the decade. And that's because on the oil side, I think if we do have this period over the next 12 to 18 months where you get a rebalancing, those oil inventories, which are at very high levels, get drawn down, then it will leave the oil market in a much more balanced position. Probably at that point there'll be a bit of support to oil prices and we'll see more production come online. Maybe OPEC will open up the taps again. And I think also what we'll see is on the fleet supply side, there were very few new tanker orders placed last year. In fact, tanker ordering in 2016 was the lowest since 1995. And so when we get to 2018 and onwards, the order book is quite small. Now, of course, there is scope for people to go out and order new ships, but I think there is a lack of financing available for a lot of owners to go and place very large orders for ships. And also we're seeing shipyard capacity shrink as well. There's some consolidation going on both within China and Korea. And so I don't think we will get over-ordering of ships for 18 and 19, which means fleet growth should be lower. And I think because we've had 2 years of very low scrapping, that fleet of older ships as well is now coming into kind of the age where we'd expect some of these ships that are 18, 19, 20 years old may start to be scrapped, particularly if we go through a weaker freight market in 2017. And another factor towards the end of the decade as well is that we may see some extra upside to scrapping from the new environmental regulations that are coming into effect on the ballast water treatment and also on the new sulfur regulations that come into place in 2020. So I think for 2017, as I said, we will probably see some headwinds and a decline in tanker earnings, but we think that the bottom might be reached in 2018. And I think given our outlook on supply and demand, the prospects from 2018 onwards are much brighter, and we would expect a pretty strong tanker market to emerge towards the end of the decade. So that's our conventional tanker market update, and we'll speak to you again next month.